Well, kia ora, and welcome to a mini pop-up Hoon with Jared Kerr, the Chief Economist for Kiwibank, who has been busy in the last few days trying to work out what's happening with monetary conditions. Put out a note on a Saturday saying that monetary conditions looks to have tightened more than perhaps the Reserve Bank wanted. And lo and behold, this afternoon, the new Reserve Bank Governor, Anna Bremen, has put out a statement saying, yes, I'm going to be speaking to some media today, and I just want to let you know that I'm going to tell them that I think the markets have got a bit ahead of themselves on rate hikes next year, because the Reserve Bank's own forecasts from a few weeks ago were that there would not be a rate hike until 2027. So that's the guts of it. But Jared, what did you think of this afternoon's statement to start with?
I thought it was good. It was needed. The market had gone way too far in forecasting rate hikes in the first half of next year. It's just simply not on the cards. She was very careful not to contradict the MPC so early on, but got the point across that the market had gone too far. Wholesale rates had lifted too much, and of course that was feeding through to retail rates.
Yeah, I mean, let's sort of dial it back a bit and go back to this last monetary policy statement on end monetary policy committee decision, which was actually just, I think, 3 or 4 days before the new governor was due to actually take her job. It was sort of a bit unfortunate and awkward. She'd been appointed to the role, but she wasn't due to start till December the 1st. So a few days before that, she had to watch but not get involved. And the Reserve Bank came out as expected with a 25 basis point cut. And the key thing there was their expectations for future official cash rates. Could you tell us what they were saying there about what they thought might happen in the next couple of years with the official cash rate?
Yeah, so the Reserve Bank in New Zealand, funnily enough, the same as the Riksbank, where Anna Bremen comes from, forecast where they think their cash rate will go, and they provide us with what we call an OCR trajectory. And we were all expecting that trajectory to keep a good chance of a rate cut in there, just given the balance of risks. So we were sort of looking for it to finish at about sort of 210, 215. That would have kept the markets quiet, but it ended at 220. Now, it doesn't sound like much of a difference, but it's a big swing in a trader's mindset to go from thinking about rate cuts to then, well, we're not very good at pricing in rates going nowhere, so they must be going up. And in the Kiwi market, we can get quite illiquid at times, particularly when people are changing their views. And what we saw were hedge funds taking off their received positions, banks faced the other way. There was basically no one on the other side, and we saw wholesale rates ratcheting higher. So wholesale rates went from factoring in, 210 to 215 cash rate to now factoring in a full rate hike by the middle of next year to 250. So that's a massive swing. And then a cash rate of 3.5% in 2027, which is just way, way ahead of itself.
Is that because that's how people in the market were thinking it's likely to develop, or were they forced to do that in a way by people in the mortgage market deciding, okay, it's not going to go any lower from here. I may as well fix for, 1.5, 2 years, 3 years, when previously I was going for the very short rates of 6 months or maybe even lower. And that sheer fact of mortgage borrowers going to their brokers and going to their banks and saying, actually, yeah, I've given up waiting for it to go any lower. I may as well fix long. And in the process of hedging their own risks, the banks have, in a way, reflected the views of mortgage borrowers on this is it.
Yeah, you're absolutely right. I agree with everything you just said. So we see that from time to time, and the flows are so chunky, they're so large. At times they can struggle to be absorbed by a market, particularly a market that's gone from pricing in cuts to pricing in hikes, that change and then the mortgage paying on top of it is huge. So from a bank's perspective, if you come to us and say, we want to fix for 6 months, well, that's fine because that's kind of matched with our term deposit maturity. So we don't really have to hedge too much. But if you come to us and say, well, actually, I want to fix for 2 years, we then go out into the swap market, the wholesale market, and we pay that rate because we're receiving your mortgage rate and we're paying a wholesale rate. And that wholesale rate just, gapped higher with people doing exactly what you said. Why should I fix for another 6 months when I can actually lock in a rate that I find quite attractive, in the mid fours for 2 to 3 years? And that's what people are doing. And that exacerbated that move in wholesale rates.
Yeah, I mean, it's quite an important time of the year as well. We're in that last couple of telescoped weeks before we all go away for Christmas, New Year. People are, if they've got a house purchase, they're finalising, or a mortgage, they're refixing. They want to get it all done really this week before, everyone goes away and no one's answering their emails anymore. So, and of course, there'll be a bunch of people spending money. And if they suddenly realise they've now got a higher interest rate to deal with than what they were assuming a couple of weeks ago, that can be a factor. Is that perhaps one of the reasons why the Reserve Bank has jumped in here? Because it's sort of unusual between decisions to actually come out and say, even in a speech, and this isn't in a speech, this is in some comments to media, to say, "Hi-ho, people, you've gone a bit ahead of yourselves."
Yeah, well, it looks like the market could have kept going for reasons that we just went through, like the bank paying. Like more and more customers will be coming to us saying, I want to lock in a 2-year rate. So we're going to have to go to the wholesale market again and again, and that can potentially push that even further. So we've seen a really big move that could go even further. So the fact that the new Reserve Bank governor came out and sort of put a bit of a floor on, or a ceiling, I should say, on that, saying, hey, look, you guys have gone too far, I think is definitely helpful. And we've seen the swap market pull back thanks to her comments today. So, I wouldn't say job done. I would say you're certainly helping, but you need to straighten out that monetary policy committee next year, because I'm sick and tired of these ups and downs and mishaps and miscommunications. It's not good enough.
Yeah, I mean, this is some sort of she's really been parachuted into a bit of a firefight here. I mean, day 2 or 3 on the job, she was in front of the select committee. Day 10, she was in front of a bunch of media. I was actually at that press conference where the questions came almost straight away. How do you feel about the tightening since the MPC meeting? And it surprised me that she was surprised about the questions. She let that one go through to the keeper, as in not answer the question, which, if you're an opening bats person, not one in an English team, but an opening bats person, you would let that one go through to the keeper and it would be okay. But in this case, actually not commenting in a way cemented it in. And now she's having to sort of clean up after the effect. What could she do, and what could the Monetary Policy Committee do in future to avoid this sort of back and forth?
Well, I think it's all about being very clear and not changing your messaging too much when it's not necessary. They were clearly cutting interest rates, right? They've cut 50 basis points in October, 25 basis points in November, and wholesale rates have gone back to levels higher than where they were in October. So you're reversing a lot of that good work that you've done with this miscommunication. So what can they do better? They need to get a better handle on how financial markets work. They have discussions, of which I'm part of, around how markets will react to different ways of speaking and communicating, and we make it very clear that if they turn around and say this is the bottom, the next move is a rate hike, the market's going to have one hell of a pop higher, and it did. And we're only talking 5-10 basis points. Like if you just put the OCR track at 2.15 or 2.10, we wouldn't be having this conversation. Wholesale rates would have moved higher because there is some signal in that move higher, and that is the better data that we've seen. And so we would have seen a little bit of a move higher simply on better data, and that would have been great. But here we are seeing a move higher because of a miscommunication, banks being faced the wrong way, hedge funds moving out of the market, and then some good news. We should just be looking at the good news.
Just as we've been speaking, Jared, ANZ has announced that they have put up their 18-month, 2-year and 3-year interest rates, including the 18-month fixed rate by 20 basis points to 4.69%, and have also added 20 basis points and 30 basis points to their term deposit rates. We saw Westpac and the Cooperative Bank last week put up their rates, which got quite a bit of attention, I think. Do you think maybe this is all a bit too late now as we crunch into Christmas?
Look, we're all facing the same lift in wholesale rates, and at the end of the day, the 2-year swap rate was up sort of 60 basis points this morning. It might only be up 50 basis points now, but that's still a lot, and that's what banks are paying on their wholesale rates. So we can either wear that in our margins or pass it on, and I think you're seeing a bit of both.
And this 50 basis points instead of 60 basis points increase in the swaps rates, and signs that some borrowers are now deciding to fix longer at those slightly higher rates than they might have hoped. What sort of impact might that have on, firstly, the housing market, I suppose, and then maybe the rest of the economy?
Well, I think it's important to point out that people are fixing at rates they find attractive, and rates that are a damn sight more attractive than they were a year ago. So the Reserve Bank has got retail rates lower, materially lower than where they were, even a few months ago. To be fair, we're just arguing over this last 50 basis points, but they have cut, from 5.5 all the way down to 2.25. So there has been quite a pass through to mortgage rates, and when they're in the fours, people get a little bit more interested. They get enticed into the market, whereas we saw the move from 7.5 to 5.5. Basically, you just saw people breathing better. You saw the weight come off their shoulders, but they weren't excited, and I think we were at rates that were starting to excite people. Definitely the investors that I've been speaking to, but also businesses, knowing that rates have dropped and are probably around their bottom. There were a few decision makers just going, I'd love to see the low in interest rates before I jump. Well, now you can jump, get in there, get involved. And our outlook, regardless of what's happened in the markets in the last couple of weeks, our outlook for next year is simply brighter, and we think that the recovery will broaden, next year.
There was this phrase in 2024, survive to 2025, and then it didn't really get going. We've seen some green shoots, but just finally, do you think we're there yet?
Well, first of all, I apologise. That survive 25 was me, and it was a client of mine who said, "For God's sake, man, I'm just trying to survive till 25." And I was like, "I'm going to use that."
Oh, that's right. Trademark. Yep.
And it just sort of took off. It was quite funny, actually. Now we're trying to think of something clever for 26, and I got nothing. I've said we'll fix in 26. Too much politics in 26. I don't know, but that is where we're looking to. We're looking to next year. We're hoping that businesses' confidence improves and turns into activity, and away we go. At least policy settings are close to right.
Jared Kerr, the Chief Economist of Kiwi Bank. Jared, thank you so much for coming on to a quick pop-up mini hoon here on the Kaka.
Pleasure. Thanks for having me on, Boo.